Today we have uh, the great pleasure of having Nellie Liang with us. And I'll tell you just a few things about her, but you probably know a lot of this already. So Nellie is currently a senior fellow at the Hutchins Center on Fiscal and Monetary Policy at Brookings. But before that, she was served as Undersecretary for Domestic Finance at the U.S. Treasury Department. And what we really know about her is for 3 decades, she's been at the Board of Governors doing a range of things, including the first director of the Division of Financial Stability from 2010 to 2017. So today we're doing financial stability, and there's nobody better to tell us about how this is working, whether it's working, and I think probably a little predictions about whether it's going to be working, than Nellie Liang. So thank you so much. Yes.
Thanks. This one? Okay. So thank you, Rob and Dick. Really appreciate the invitation to be here. I'd agreed to come. I think I was invited, earlier this year when still at Treasury, thought I would be taking more time off than I've seemed to have been able to. And I said, I could come and I'd like to talk about Treasury markets if it fits into your agenda. I had no idea, of course, what was to come. So here we are. And I've had to adapt some of the Treasury market discussion to current events, but very glad to be here and the opportunity to talk to everybody here. And it's great to see so many people. So I'm going to talk about Treasury market efforts that we've taken in recent years to strengthen the resilience and what is still to come. And resilience of this market has always been a priority. And I want to make a case today that it's ever more important now. We have Treasury debt projected to continue to grow very quickly. And it seems that chaos and uncertainty are now part of our policy making. And so shocks could be bigger. And that's changing the way the world may be seeing U.S. Treasury securities. We all know the Treasury market is a critical market. I'm going to say this just because it's important to say. It is key to financing the U.S. government at the lowest cost to the taxpayer. It's an important channel for Fed's monetary policy, and it provides the benchmark risk-free yield curve. And it's a safe asset, and it's used by many financial firms, banks and non-banks, to meet liquidity needs and to manage their risks. And a few examples for non-banks. Non-banks don't have access to the government backstop. That's one definition. But stable coins hold treasuries as a reserve assets to help maintain par. Hedge funds get good lending terms on treasury collateral. Open-end bond funds use treasuries to manage their liquidity mismatch. Treasuries are very pervasive to the way the whole system runs. And it can serve the Treasury market can serve these critical functions because it is the deepest, most liquid market in the world. I've been taught that by our debt management team. I have to say that every single time. But it's achieved this distinction because it's supported by, a strong U.S. economy that has been supported and continues to be founded on rule of law and protection of creditor rights and institutional policy frameworks. It also relies on an efficient and a stability-enhancing regulatory and market structure for Treasury markets. And I think our goal is to help ensure that this structure is maintained and helps keep market liquidity elastic and resilient. So that's what I want to talk about. So in the past decade or so, we've seen a couple cracks. Nate referred to some of these earlier. And then we saw like significant dysfunction in the desk for cash in March 2020 at the onset of the COVID pandemic. And in response to these events, and as also changes that have been happening in the markets, which I'll mention later, there was an interagency group, working group, the IAWG, that took a comprehensive approach to strengthening this market. So I want to focus on that today. And I really do want to give a shout out to the IAWG. It included staff from the Fed, which includes the board, New York and Chicago, the SEC, the CFTC, and Treasury. And they've really worked hard for the past few years to push forward this agenda. I really want to give a special thanks to the Treasury debt management and the fiscal teams. Very dedicated public servants. They had to learn, they're responsible for how much do we need to finance, determining the schedule for auctions, what kinds of securities to issue, and then to manage about 500 auctions a year. It's a very lean team. So they're, I think, as you know, you might not be surprised. I think there are some very dedicated public servants, and I hope they're surviving the current environment. Okay, so let me first turn to some current events because we can't ignore those. So policy uncertainty has become really massive in recent weeks. And of course, financial market volatility has shot up. And the tariffs that were announced on April 2nd, Liberation Day, were much bigger and broader than expected. And that really set off a volatile period for many financial markets, treasury markets, equity markets, the dollar. And you've seen many narratives, and I'm not going to talk through. Matt, this is supposed to do something here. Okay, thank you. That one. Okay, thank you. You've seen a lot of narratives here, so I'm not going to repeat those, but with all the back and forth. But after sort of on that, just to give you a picture of what's happened to the Treasury yield curve. The dotted line, I guess, is the day before Liberation Day. In the midst of the line that is dashed, which is April 11th, was sort of at the height of uncertainty. It had gotten past that really terrible day, but then long yields started rising towards the end and people started getting very nervous. So you can see how rates had just risen all across the board. Since then, there's been a little bit of back off on some of the policies, a little bit of uncertainty. And you can see now we just have a steeper yield curve. Now, 10-year rates and 30-year rates are probably 40 to 50 basis points higher than prior to this episode. That's pretty significant. So generally a higher oh dear, sorry. Okay. Generally a higher interest rate on dollar investments should strengthen the dollar. But that's not the case. And as rates rose, the dollar fell. And you can see as an example, the dollar to euro rate on the right-hand side. Clearly, some investors are attributing some of the rise in rates and this falling dollar as evidence of Treasury securities losing some of their preeminent status as a global safe haven. And there's been actually, even within the last couple of weeks, a couple papers that I'll just call out. It's kind of amazing. I got one last night, but one of them is, there's a piece by Zhang and Krishnamurthy et al., and they construct a synthetic Treasury security from German bonds hedged into treasuries, and then they match that against the yield on an actual Treasury security. And that basis, they call that the basis, has widened a lot, like 8 or 10 basis points over like the last 3 weeks. So it's a significant thing. And then the loss, and then another paper, which is by Viral and a number of people, I just got this last night. They note this change in correlation, not only between rates and the dollar, but rates and equities. And so at the long end, they find it's very consistent with a reduction in the asset hedging properties of treasuries. So we're losing a lot of convenience yield. And they also have a subtle thing, which I haven't looked at, but at the short end, there's still some value in the treasury. So there's like mixed pictures, but there's a lot of research. This is all in the last couple of weeks. So it's it'll be something to follow. So I don't have a view on where we're going to end up, but it's really important for all of us to be like looking and trying to understand these moves. So in addition to the concerns about the US treasuries as a reserve currency and a safe asset, investors also began to question whether the markets were becoming dysfunctional. I think this was Andrew's question. Was it the plumbing or is it like economics? Clearly, the 3-year auction, some of you didn't go that well, and that set off concerns. And people were very concerned about some hedge funds leveraged, having to unwind positions. Whoops. Okay. So let me just provide, and this is so one thing we know about treasury markets and liquidity is that public measures are really hard to come by. So that's like one thing. Okay. So I'm going to show this one measure called market depth. And when I was in Treasury, we would also look at bid asks and price impact and other things. But if you're on the outside, you don't get access to all this anymore. So, and this was provided courtesy of JP Morgan based on broker tech data. So the left side is market depth, and it's a long time series here. And it's the sum of the 3 bids and offers by Q position in the mornings for cash treasuries. You can see sort of at the end in 2025, recently it fell. It's not as low as it was in March 2020 or in March 2023, which were the bank failures, the SVB bank failures. To the right, I plotted this measure of market depth against the MOVE index, which is interest rate vols. Okay, so as you can see, there is this inverse correlation. If you have higher interest rate volatility, you have lower market depth. That's not surprising. It's what you would expect. People pull back on risk taking when they. So a few observations about this. The dark blue represents March, April 2020. And the bottom quadrant shows that for that amount of volatility, market depth was like way below sort of the typical. And this is the period in which the Fed intervened and purchased securities. The yellow squares are March 2023. And then the red is current. So this is, yes, volatility went up, market depth fell, but it's not really unusually bad. In fact, it might even be towards the comfortable range for given the volatility. So again, this is one measure, and so there's some issues with it, but we would love to see some other parts of it. But I do think this suggests markets did continue to function. We have some separate data on trading volumes, which are now public. That was one of our IAWG work, and it's about double the normal levels of trading. So normally you'd see 800 or 900 billion of trading. I think I have my units right. And it's like double that. So it's a lot of trading that's going on. Okay, so this is not a repeat of March 2020. Treasury prices are falling, the yields are rising, but it's not because participants can't transact. I guess the second point to make from this chart is, though, that market liquidity is hard to predict. So some of those blue, I pointed to the blue dots in the lower left. Some of those blue dots are also up, like that one at 160, that one, that's also early March. So, it's like you can move very quickly. Liquidity can disappear and evaporate very quickly. So I think those are 2 points from this chart. Okay. So I actually testified to Congress recently on this Treasury Market Resilience work. They wanted to know how it was going, that kind of thing. And I emphasized the importance of all the work after March 2020. And I also pointed out that the Fed had intervened in March 2020 to buy securities to support market functioning. And fortunately, at that time, its objectives for market functioning were fully aligned with its monetary policy objectives for price stability and full employment. But we should anticipate a time when those policy objectives aren't aligned. And it seems to me that such a scenario is much more possible now. And that scenario makes it even more important for us to be continuing to strengthen the Treasury markets and its resilience. Okay, let me turn to my next. So the second thing I want to talk about is some of the reform efforts that we've done and what the work was in the program. And we had 5 work streams, and I'm not going to talk about all of them. But our starting point for these work streams was to recognize that there's actually been a lot of sort of ongoing structural changes in the Treasury market over the past decades. And as usual, regulation sort of catches up, right, as things happen. So there was electronic trading is much bigger. Principal trading firms now are about half of the trading in Treasury cash. The dealers post-GFC, traditional securities dealers have pulled back. Part of it's capital standards, part of it's their own risk management standards. Treasury debt, I'll use this chart. Treasury debt has grown rapidly. You can see it sort of jumped up after 2008, took another up after 2020. This is about 28 or 29 trillion of Treasury securities. And as Nate said earlier, it's expected to go to 50 trillion over the next decade. That's quite a bit of debt. And then the investor base is becoming more price sensitive. And what I've charted here is the share of the less price sensitive part of the markets, which are easier to identify. So at the bottom are the depository institutions. The yellow is the Federal Reserve, and the top is rest of world, foreign official and private. But between 2015 and now, this share has gone from more than 70% to about 50%. That means a lot, that 20% is being held in mutual funds, hedge funds, pension funds, insurance companies who are much more price sensitive. I learned this morning that pension funds are much more price sensitive than I thought. Like like they're big. We thought maybe they were a bit more stable than, say, hedge funds or mutual funds, but now I'm not quite so sure. So let me just talk about a few of these reform efforts, some of the 5 work streams that I thought would be of particular interest to this audience. The first is just what we've done to improve data quality and transparency. And here, of course, this is a public good. It's also really important for researchers to understand like a bunch of the new data that we've gotten out there. So first, we put out a lot more data on Treasury transactions. For trading volumes are available on a daily basis. It sounds silly, but like in March 2020, outsiders who wanted to know how much volume in the market, we knew prices, but you couldn't get volumes. And you got them a week later and you'd get an average for the previous week. And it just like didn't make any sense. So now these are out every day. And it does help you when you see prices understand our volume, what kind of volumes are underlying that. We also started putting out price and quantity data for on-the-run securities at a transaction level. And there are caps on the volume, but to protect positions, but it's provided each day now for on the runs. And so this represents about half of the daily trading volume and 75% of all the nominal securities. So that's a big thing. OFR, we started a new data collection for the non-centrally cleared bilateral repo, which closes this really important gap in the repo market. And it will, for the first time, provide authorities, even authorities with the data to monitor a part of this segment that's been opaque since before the global financial crisis and where significant risks arose in March 2020. This data cover more than $2 trillion. It's about 45% of the repo market. We started in December 2024. I just got a little sneak peek of what is coming in. Hopefully it'll continue and it'll continue to improve. It was a multi-year effort. I mean, in fact, the very first data pilot was done in, say, 2013 or 14 when Dick was director. It got put on hold. We did a new pilot when we started because that felt like a little too old. We got the pilot through. We got the data started. Hopefully that's going to be a big improvement for authorities and the public. And then on hedge funds, the SEC has been collecting more information on hedge funds from Form PF. Of course, they're proprietary, but we've made some efforts to get some of that information out to the public. So if you go to OFR, they've created an interactive data monitor with aggregate data on hedge funds. And so you can see at least aggregate trends, which again is something, sounds like a small step, but there really wasn't anything. So if you go now, you could see that both repo and prime brokerage borrowing of hedge funds has been increasing pretty significantly for the last couple of years. Both turned down in the Q4, 2024 Q4, but they've been rising a lot. But you can also see that leverage of the largest 10 hedge funds haven't really risen that much over this period. So it's, again, it's aggregate, it's not individual, but it gives the public and even authorities better insight into what's going on in that sector. A second priority, other than the data, is to improve the resilience of market intermediation, and this is a pretty key one. The SEC's rule for central clearing of Treasury securities is huge, potentially transformative to the market. Nate has written on this, called it reassembling the Treasury market. I mean, it's kind of big. So central clearing, of course, is used for other assets like equities or exchange-traded derivatives. And it can really reduce risk, one, by standardizing risk management practices, which is important. And it can also increase intermediation capacity of bank-affiliated dealers because bank capital and leverage requirements can recognize the risk-reducing effects of multilateral netting of centrally cleared trades. So this is like a big deal. And it also gives some greater visibility into what's going on in the market. So the new mandate is going to lead to a significant increase in the volume of transactions to be cleared. Treasury clearing activity is expected to increase by more than $3 to $4 trillion. That's adding $3 to $4 trillion of transactions to central clearing. And there's an expected 7,000 new relationships that need to be created between direct and indirect participants in advance of the mandate taking place. So a lot of work is being done on master agreements and is done. SIFMA and all of them are working on this. So a key issue related to the significant volume of central cleared transactions is there's one CCP for US Treasuries now, and that's FIC. And that's adding almost 30% volume to an already big CCP. But both CME and ICE are preparing to enter, and CME has quite a substantial application into the SEC. My view is entry can definitely lead to greater competition and innovation. It's going to bring different clearing models to the sector. And from a macro perspective, there's some benefits to operational resilience from multiple CCPs. There are, of course, some potential costs, aside from the transition costs. There are some concerns that the trading costs could increase. If you're doing a lot of transactions at zero haircuts, this will probably reduce some of that. So that there's that. So there's complicated operational, regulatory, accounting issues. There's concerns that we could have higher costs in the future. So there will be, but the industry groups are actively engaged. They're quite committed to implementing these next steps. It's going to be very important to keep an eye on how it affects intermediation capacity. Does it really increase it, which is which is a key goal? What it does to leverage in the system, because how margins will be set, how cross margins between cash and futures will be set, will be really important to how much leverage in the system you have. It potentially is another tool, but if it's not set on a holistic basis, it you could end up with actually more leverage. So I think this is something the regulators will be paying very close attention to. So following up on leverage, another issue that everyone is talking about is, should changes be made to the supplementary leverage ratio? And currently, as you know, the SLR requires banking firms to hold the same amount of capital for, say, riskless reserves at the central bank as they would for a corporate bond or a risky asset. And to the extent this ratio is binding and it's not functioning as a backstop as it's meant to be, it does feel like appropriate to adjust it. One change that has been proposed is to exclude central bank reserves and perhaps Treasury securities in the trading book, which is a pretty small element. I would argue, though, that you should not exclude all treasuries, that because capital rules at this point may not capture interest rate risk. We saw in March 23, interest rate risk is real. And so to the extent you want to adjust an SLR, you need to make sure that interest rate risk is still captured and that you're not really taking capital out of the system at this point in time. It's a risky environment. It's a riskier environment, much riskier than we would have thought. And it seems like an inappropriate time to do it. There are complicated ways to adjust SLR that could be done, and I think these should be explored. One, I know the Fed, and I believe the OCC had talked about calibrating an SLR to half the GSIB surcharge. It sounds complicated, but you do want some capital charge for treasuries. You just don't want them to go to zero. One I always like is to make the ESLR buffer countercyclical. It's so natural to me that you would have a buffer to be released when you need it, and then you rebuild it to use, so it's used again later. But many people just say that's too complicated, but I just would not want to have to take that off the table. Okay. So we've had, I guess the next step, and just to call out, so we've had several years of work. We've had some experiences, and now with March 2023 and how important it was that the big banks were strongly capitalized. I mean, I think we underestimate how important that was to the stability of the system. And it wasn't, we don't often talk about the emergency backstops that were done. But there were actually some significant emergency backstops, and they could have had to been much bigger had the big banks not been well positioned. And so just to keep that in mind. The next step for all this resilience work, and it's something we set out at the beginning, but thought we need to like make more progress before we get there, is to better understand how all these different things interact with each other. It's pretty clear how central clearing is going to affect intermediation capacity. So it would SLR, and these are connected. At the same time, the Fed has put in a standing repo facility, which can handle periods of stress. The Treasury Department has a limited buyback program for off-the-run Treasury securities, which can help also ease some balance sheet pressures. So how these all interact, I think, is an important thing to be spending time on. It's also possible with all the increased disclosure, we could move to some more all-to-all trading, which reduces some of the demand for the intermediation. And I think SIFMA has in mind that some of the central clearing and disclosure could get you there. And as I mentioned, the margins and the cross margins are extremely important for thinking about this. Okay, so let me just conclude. I've probably gone too long. One, just to make a few points. One, Treasury markets are working. Prices are falling, but it's not because of lack of liquidity. There's certainly more uncertainty for downside risk for US assets. Two, resilience in market liquidity is ever more important. As I said, the Fed may not have as much ability to respond to a similar event in the future if inflation stays above target. And second, if, as I mentioned, if chaos and uncertainty are sort of the dominant investment themes for the near term, and interest rates are going to be higher, we're going to have higher interest rates and maybe lower value for dollar assets. We have also this rising Treasury debt. And so we're just setting up the conditions for a really bad self-reinforcing cycle of higher rates and rising debt and higher rates. And so we're creating much bigger risks to fiscal sustainability than had been in the past. And then third, I think I would just mention the importance of making sure capital in the banking system is strong given these higher risks. And so, okay, then I'll stop there. So thank you very much for your attention.
I think we have time for a couple questions. And so let me ask the first one. I've always been interested in how uncertainty affects financial markets. And you've really talked about it here. What I didn't hear is whether you're seeing effects of this uncertainty on the volume of transactions in the treasuries. We see it in the prices. You see it in the volume also. And I guess volume, of course, is both supply and demand, but you'd expect to see that. Actually, I don't know whether you need that.
Yeah. So in the most, I didn't bring this chart. This is public data now, so you can all look it up. And started in February 2023, where we have daily transaction volume on Treasury markets. And what we've seen in the past few weeks is, so normally it's about 9 trillion. I'm getting my units wrong. I think it's trillion. It's gone to like 15 trillion. It's like really, it's almost gone up 50%. It's huge. Really? So that's the other piece of the market functioning. Markets are working. We don't have all the real detail in other episodes, but that to me is like an important piece of the discussion. Yeah.
Thank you. Yeah. Questions? I see one. Mustafa in the back.
I'm Mustafa Chowdhury, former head of rates research at Deutsche Bank. Secretary Bessent has mentioned several times in the last couple of months that to eliminate SLR for smaller banks, not necessarily all banks, but the smaller banks. Isn't that a good thing to absorb all this huge tidal wave of supply that's coming?
So I think, there's, as I tried to say, I think SLR should be a backstop capital requirement. The principle of, we should have capital for interest rate risk of Treasury securities. So I think in principle, you want to adjust SLR if it is not the backstop. But you want to make sure that somewhere in the system, either the SLR, the tier 1 leverage ratio, the risk-based capital ratios, or whatever ratios, there should be some recognition of interest rate risk for treasuries. So I think we would not want to necessarily push Treasury securities. That would not be a principle I would start with, to push Treasury securities into the banking system just for that purpose.
Thanks.
Yeah. Oh, no. You're not allowed to ask a hard question. Okay.
Now it's okay because they don't work for you anymore. You brought up a really interesting and scary topic, which is rising debt levels and rising interest rate levels. And when you hit a point where the feedback loop gets difficult. And we've seen some countries, often emerging markets, but you could even argue a little bit the Truss episode in the UK was a little bit like this, that when there's a place where you start to climb over the cliff.
Yeah.
Have you seen any good work about what that might be for a country like the US with all our wonderful exorbitant privilege, et cetera? What sorts of levels it would take to get to that sort of edge?
Yeah.
Any insights on that?
Yeah. There's no magic. So I don't have great insight. So there's no magic ratio of Treasury debt to GDP. All I can say is, though, if we lose some of the reserve currency status, some of the safe haven status, and we have higher interest rates on average, it has raised the risk. And I think that's really all you can say. It is, and I think it's a very significant concern. And, it's an issue Congress has to deal with as they're thinking about the budget in terms of spending plans and revenue plans and how to think about the path for interest rates. But we've added some uncertainty to that interest rate path. Not just uncertainty, we've added maybe a longer, we don't know how long it'll last, but it's certainly a risk that there's a extra bunch of basis points in there.
You've mentioned a lot about the resilience in this very volatile, much larger Treasury market. Maybe it's a boring subject, but how important has it also been in terms of resilience to going from a settlement from T+2 to T+1, which is just recent? That's a huge increase in liquidity. And the other one that I'm thinking about is this clearinghouse importance in terms of counterparty risk.
Yeah.
See, can you comment on those two factors?
Yeah. Well, from T+2 to T+1 reduce some settlement failures and stuff. I think it's really, it's helped liquidity for sure. Maybe with digital, we'll go to T+0 or instantaneous, but that's a move. So CCPs, this is very significant. I think as the IAWG, the group that worked on this, it was a big consideration of you're going to concentrate risk in a single CCP. It will take counterparty risk out of every transaction, but you now have one CCP. So in my view, having more than one CCP is a good development. Of course, we don't know how it will work out, but they can offer, certainly it's going to bring some innovation. Absolutely. It's bringing competition already. We have different client access clearing models. I think it has the potential to have real benefits, but we'll really have to pay attention to how all these things get resolved. There's such big implementation issues. I mean, it's just, they've delayed by a year all the implementation, and rightly so. It's very complicated. But on net, it's not like just there's a magic path there and it's all going to be better. There's like a lot of checks to make along the path there to make sure you end up in a better place. Okay. Last one.
This may seem like an off the wall kind of question, but I can imagine there's a scenario where the federal government would have a strong incentive to fudge CPI numbers. Could that be perceived as a de facto default in the TIPS market and be destabilizing?
Do I have to answer that? I am not. As I said, okay, our new policy regime is uncertainty and chaos. And so there's in many dimensions.
Thank you so much.